In 2020, Callaway Golf, a legendary 60-year-old American company that revolutionized the game of golf, made what looked like the boldest, smartest move in its history. They paid $2.6 billion to acquire TopGolf, the trendy entertainment venue that was bringing millions of young people to the driving range. It was supposed to save Callaway from declining golf equipment sales and transform them into a modern entertainment powerhouse. Fast forward just 5 years to 2025, Callaway just sold TopGolf for $1.1 billion, losing $1.5 billion in value. They reported a staggering $1.51 billion quarterly loss. Their stock, which hit $37 per share in 2021, collapsed to under $10. Shareholders lost 73% of their investment. The company is scrambling to pay down debt, slashing jobs, and desperately trying to return to their roots. This is the story of how one of America's most iconic golf brands bet everything on a flashy entertainment concept and watched it destroy them. This is the story of how TopGolf didn't just fail Callaway, it nearly destroyed a 60-year legacy. If you find economic stories like this fascinating, where we uncover the financial disasters that happen while most people weren't paying attention, please hit that like button and subscribe to the channel. And don't forget to turn on notifications because we're just getting started with these economic mysteries that shaped our world. Chapter 1. The $400,000 Miracle. To understand how devastating this disaster truly was, you need to know what Callaway Golf meant to the world of golf. In 1982, a 65-year-old former textile executive named Ely Callaway Jr. invested just $400,000 into a struggling company called Hickory Sticks USA. Most people would call that retirement money. Ely Callaway called it the beginning of a revolution. By 1988, he'd renamed the company Callaway Golf and released the S2H2 driver, which used a radical, short, hollow hustle design that redistributed weight and made the club more forgiving. Golfers loved it, but Ely wasn't done. In 1991, Callaway Golf launched the Big Bertha driver, a massive headed driver that was so revolutionary, so different from anything golfers had ever seen, that it became an instant cultural phenomenon. The Big Bertha didn't just sell well, it dominated the market. By 1992, Callaway Golf was the #1 golf club manufacturer in the United States. The company went public, and Ely Callaway became a legend. Throughout the 1990s and early 2000s, Callaway Golf introduced innovation after innovation: titanium drivers, carbon fiber clubs, premium putters, and golf balls that competed with industry giant Titleist. By the time Ely Callaway passed away in 2001, he'd built a $1 billion company from a $400,000 investment. He'd created a brand synonymous with quality, innovation, and American craftsmanship. Callaway wasn't just a golf company. It was the golf company, trusted by professionals and weekend warriors alike. But then came the 2010s. Golf participation in the United States started declining. Millennials and Gen Z weren't picking up golf clubs like their parents had. Courses were closing. Equipment sales were flattening. Traditional golf was aging and Callaway knew it. By 2015, Callaway's stock was struggling. Revenue growth had stalled. The company needed something, anything, to jumpstart growth. That's when they noticed something interesting happening in suburban parking lots across America. Massive 3-story structures were popping up, filled with young people drinking beer, eating nachos, and hitting golf balls at giant targets with colorful lights and loud music blaring. It wasn't golf as Ely Callaway knew it, it was TopGolf, and it was printing money. In 2014, Callaway invested $15 million in TopGolf, taking a small equity stake. It was a smart hedge, a way to participate in this new entertainment golf phenomenon without risking the core business. By 2019, they'd increased their stake to 14%, investing a total of about $270 million. TopGolf venues were expanding rapidly. Wait times were hours long. The business model looked unstoppable. And Callaway's leadership asked themselves a dangerous question. If TopGolf is the future of golf, shouldn't we own all of it? Chapter 2. The $2.6 billion gamble. On October 27, 2020, In the middle of a global pandemic, Callaway Golf announced a deal that would change everything. They were merging with TopGolf in an all-stock transaction that valued TopGolf at approximately $2 billion. Including Callaway's existing 14% stake, the total implied value was about $2.6 billion. Here's how the deal worked. Callaway would issue approximately 90 million new shares to TopGolf shareholders. After the merger, Callaway shareholders would own 51.5% of the new combined company, and TopGolf shareholders would own 48.5%. The company would be renamed TopGolf Callaway Brands Corporation. Chip Brewer, Callaway's CEO, would lead the combined entity. On paper, the strategic rationale made perfect sense. TopGolf was introducing millions of new, younger players to the game of golf, exactly the demographic Callaway desperately needed. TopGolf venues used Callaway equipment and sold Callaway clubs in their pro shops. The merger would create synergies, that beautiful corporate word that makes investors salivate. Chip Brewer presented a compelling vision. Callaway would handle the equipment side, TopGolf would bring the entertainment and venue experience, and together they'd create an unstoppable golf ecosystem. TopGolf had 60 venues generating strong same-venue sales growth. They planned to open hundreds more locations globally. Projected revenue growth looked astronomical. Wall Street initially loved the deal. When the merger closed in March 2021, Callaway's stock hit an all-time high of $37.29 per share. The market cap exceeded $6 billion. Analysts wrote glowing reports about the new Callaway and how they'd successfully pivoted from a sleepy equipment manufacturer to a dynamic entertainment and golf conglomerate. Chip Brewer's compensation package reflected the optimism. He made over $9 million in 2021 alone. But there was a problem lurking in the fine print, a problem that would eventually destroy billions in shareholder value. TopGolf's business model was extraordinarily capital intensive. Each new TopGolf venue cost approximately $30 million to build. Even with creative financing structures where TopGolf would put up $7.5 million in cash and then sell the property to a real estate investment trust, the expansion still required massive amounts of debt and ongoing construction costs. Before the merger, TopGolf had been a private company, shielded from the quarterly earnings scrutiny of public markets. They could afford to grow aggressively, finance expansion with debt, and worry about profitability later. But now, as part of a publicly traded company, every venue opening, every construction delay, every interest payment would be visible to shareholders and analysts. And there was another issue: timing. The merger closed in March 2021, just as the US economy was about to enter a period of historic inflation and rising interest rates. Construction costs were about to explode. Labor shortages were about to hit the hospitality industry. Supply chain disruptions were about to delay venue openings. And consumer spending was about to shift dramatically as pandemic savings dried up. Callaway had just bet the entire company on an expensive, debt-fueled growth model, right before the economic environment turned catastrophic. Chapter 3. Warning signs ignored. The first cracks appeared in late 2021 and early 2022. While Callaway's golf equipment business remained stable, TopGolf's financials started showing strain. Venue construction costs, which TopGolf had projected at around $30 million per location, were suddenly running 15-20% higher due to inflation. Steel, concrete, and technology components all skyrocketed in price. Even worse, interest rates started climbing. In early 2021, the Federal Reserve had interest rates near zero. By the end of 2022, rates had jumped to over 4%. TopGolf Callaway brands carried billions in debt to finance TopGolf's expansion. And suddenly, that debt was getting dramatically more expensive to service. Interest expense jumped from $115.6 million in 2021 to $210 million in 2023, an 82% increase in just 2 years. Then came the operational problems. TopGolf's same-venue sales, the most critical metric for any venue-based business, started declining. In 2023, same-venue sales dropped 3%. In 2024, they plummeted 9%, and in 2025, they fell another 10%. The novelty was wearing off. Customers who'd initially been excited to try TopGolf weren't becoming repeat customers at the rate TopGolf had projected. Price-sensitive millennials were cutting back on $200 nights out at TopGolf as inflation squeezed their budgets. Competition was also heating up. Drive Shack and other TopGolf imitators were opening venues, fragmenting the market. TopGolf was no longer the only game in town. Their first mover advantage was evaporating. Throughout 2022 and 2023, Callaway's stock began a brutal, relentless decline. From that March 2021 high of $37 per share, the stock fell to $30, then $25, then $20. By mid-2023, it was trading around $59. Shareholders were getting massacred. The stock had lost 60% of its value in just 2 years. But the worst was yet to come. Financial analysts started asking uncomfortable questions on earnings calls. Why were same-venue sales declining? When would TopGolf become cash flow positive? How much more debt would the company take on to finance venue expansion? Why weren't the promised synergies between Callaway's equipment business and TopGolf's venues materializing? Chip Brewer's answers became increasingly vague and defensive. He talked about long-term vision and strategic positioning and temporary headwinds. But the numbers told a different story. TopGolf was becoming an anchor dragging down the entire company. By August 2024, the situation had become untenable. The stock was down 24% just since January. Activist investors were circling. Credit rating agencies were issuing warnings. Callaway's core golf equipment business, which had been healthy and profitable for decades, was now being punished by Wall Street because it was tied to TopGolf's disaster. The Callaway board of directors faced a stark reality. If they didn't do something drastic, TopGolf wouldn't just hurt Callaway's stock price, it would destroy the entire company. Chapter 4. The $1.5 billion collapse. On September 4th, 2024, TopGolf Callaway Brands issued a press release that shocked the golf and business worlds. They announced their intention to separate into 2 independent companies, Callaway Golf Company and TopGolf. The spin-off would be completed by mid-2025. In corporate language, the announcement talked about unlocking shareholder value and allowing each business to pursue its strategic vision. But investors understood what was really happening. Callaway was admitting the merger had been a catastrophic mistake. They were divorcing TopGolf to save themselves. The financial details were stunning. Callaway would retain all of the combined company's debt, approximately $2.4 billion. TopGolf would be spun off debt-free, with approximately $200 million in cash. In other words, Callaway had saddled itself with years of debt from financing TopGolf's expansion, and now they were getting rid of the very asset that debt was supposed to support. But the announcement didn't stop the bleeding. Throughout late 2024, same venue sales at TopGolf continued declining. The company laid off employees, venue openings slowed to a trickle, and then in February 2025, TopGolf Callaway Brands reported their fourth quarter 2024 earnings. The number was almost incomprehensible, a $1.51 billion loss. $151 billion in a single quarter. It was one of the largest quarterly losses in the history of the golf and entertainment industries. The loss stemmed from write-downs, goodwill impairments, and the recognition that TopGolf was worth far, far less than Callaway had paid for it in 2020. Shareholders were devastated. The stock, which had briefly recovered to $18 in early 2024, crashed back to around $10. From the peak of $37 in 2021, that represented a 73% decline. An investor who'd put $100,000 into Callaway stock at the peak now had just $27,000 left. Billions in shareholder wealth had simply evaporated. Chip Brewer, the CEO who championed the TopGolf acquisition, faced mounting pressure. His compensation, which had exceeded $9 million in 2021, was now under intense scrutiny. Board members were fielding angry calls from institutional investors. Credit agencies downgraded the company's debt rating. And then came the final indignity. In November 2025, TopGolf Callaway Brands announced they'd found a buyer for TopGolf, Leonard Green and Partners, a Los Angeles-based private equity firm. The sale price $1.1 billion for a 60% stake, implying a total TopGolf valuation of approximately $1.83 billion. Remember that Callaway had valued TopGolf at $2.6 billion in the 2020 merger, and that was before Callaway invested hundreds of millions more in expanding TopGolf venues. In just 5 years, TopGolf had lost 30 to 40% of its value. Callaway had destroyed approximately $1.5 billion in shareholder wealth. It was one of the worst mergers and acquisitions in modern business history, and Callaway shareholders had paid the price. Chapter 5. The Fire Sale. The Leonard Green and Partners deal, which closed in January 2026, revealed just how desperate Callaway had become. Private equity firms like Leonard Green are famous for buying distressed assets at fire sale prices, restructuring them, and selling them for profits years later. The fact that Callaway had to sell to private equity at a massive loss spoke volumes about TopGolf's condition. Here's what Callaway got from the deal. Approximately $770 million in net proceeds after adjustments and transaction expenses. They used that money immediately to pay down $1 billion in debt. They also announced a $200 million stock buyback program, hoping to prop up their battered share price. And they got one more thing. Permission to change their name back to Callaway Golf Company. The TopGolf Callaway brand's name, once seen as representing a bold new vision, had become toxic. They wanted to erase it and return to their heritage brand. Here's what Callaway kept: a 40% minority stake in TopGolf, which Leonard Green would now control, and all of the remaining debt, approximately $1.4 billion, even after using the sale proceeds to pay down $1 billion. That debt carries interest expense of roughly $140 to $180 million per year, depending on interest rates. For context, Callaway's traditional golf equipment business generates annual revenue of about $2 billion. They're now servicing massive debt loads with a mature, slow-growth equipment business. Meanwhile, Leonard Green got themselves a deal. They acquired majority control of 60-plus TopGolf venues, generating approximately $1.5 billion in annual revenue. They paid $660 million in cash, 60% of $1.1 billion. If they can stabilize same-venue sales, cut costs, and improve margins, all things private equity firms excel at, they could potentially flip TopGolf in 3 to 5 years for a significant profit. In other words, Leonard Green might make hundreds of millions from the very asset that destroyed Callaway. The golf industry's reaction was brutal. Industry publications ran headlines like Callaway's TopGolf disaster, how to destroy $1.5 billion in 5 years, and the worst golf merger ever. Analysts who'd praised the deal in 2020 now wrote scathing reports explaining how they'd been wrong. Chip Brewer, remarkably, kept his CEO position, though his compensation package was restructured to include more performance-based incentives. The Callaway board argued that separating from TopGolf gave the company a fresh start, and Brewer deserved a chance to restore Callaway's equipment business to glory. But shareholders weren't convinced. Class action lawsuits were filed, alleging that Callaway's management had misrepresented TopGolf's financial condition and growth prospects. Some of those lawsuits are still working their way through courts. One thing is certain. Callaway Golf, the company Ely Callaway built from a $400,000 investment into a billion-dollar American icon, will spend years, perhaps decades, recovering from the TopGolf disaster. Chapter 6. Lessons in Billions. So what can we learn from Callaway's $1.5 billion TopGolf disaster? This story offers critical lessons for investors, business leaders, and anyone trying to understand how major corporations make catastrophically bad decisions. Lesson 1. Question the synergy story. Every major merger announcement talks about synergies, the magical benefits that supposedly arise when two companies combine. In Callaway's case, the synergy story was that TopGolf would introduce new golfers who'd buy Callaway equipment. Sounds great, but did it actually happen? There's little evidence that TopGolf customers, who were mostly casual, entertainment-focused, became serious golfers, buying $500 Callaway drivers. The promised synergies were largely imaginary. When you hear synergies in a merger announcement, demand specific, measurable evidence. Otherwise, you're investing in hope, not reality. Lesson 2. Debt-fueled growth is dangerous in rising rate environments. TopGolf's business model required billions in debt to finance venue expansion. That model worked fine when interest rates were near zero, but when rates rose from 0% to 4 to 5%, interest expenses nearly doubled. If you're evaluating any company with significant debt, ask yourself, how would this business perform if interest rates doubled? If the answer is badly, you might want to reconsider your investment. Lesson 3. Same-store sales are everything in venue-based businesses. For any business built on physical locations, restaurants, gyms, entertainment venues, same-store sales growth is the most important metric. It tells you whether existing locations are getting more popular or less popular over time. TopGolf's same-store sales declined 3 years in a row. 3%, 9%, 10%. That's a death spiral. The novelty was wearing off, and no amount of new venue openings could fix the fundamental problem. Customers weren't coming back. Lesson 4. Be wary of mergers that transform a company's identity. Callaway was a 60-year-old golf equipment manufacturer with a proven, profitable business model. TopGolf was an entertainment venue operator with a completely different business model, cost structure, and customer base. When Callaway tried to become both, they lost focus, their equipment business suffered from neglect, and TopGolf's problems infected the entire company. Lesson 5. Management's track record matters. Chip Brewer and Callaway's management team had decades of experience running a golf equipment business. They had zero experience running a venue-based entertainment business, yet they bet the entire company on their ability to do something they'd never done before. Finally, remember this: Callaway's disaster wasn't caused by bad luck or unforeseeable circumstances. Warning signs were everywhere. Declining same-venue sales, skyrocketing interest expenses, rising construction costs, increased competition. But management ignored those signs, hoping things would improve. They never did. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial, educational mysteries.